Welcome to Picture Me Coding. My name is Eric Aker. My co-host, Mike Moll, is with me today, as always. Hello, Mike.
Hey there.
Mike, today we have a very good and long-standing friend of mine, Bob Farzin. Welcome, Bob. Thanks for coming on the show.
Hey, thanks, Eric and Mike.
Bob has experience as a software engineer, but in related fields that we have never worked in. So Bob's worked in finance and investing and a lot of kind of interesting areas, I would say. And today I wanted to invite him on in order to tell us a little bit about high frequency trading, an area of software engineering I know virtually nothing about, and I've kind of heard legends about. So it's like these people are out there and they're fighting dragons and stuff. And I'm curious if that's really how it works in the field. Bob, would you tell us a little bit about your background?
Sure. Well, thanks for having me on this show. I'm definitely excited to be here. Long-time listener, first-time caller. So I'm thrilled about that. And so a little bit about my background. I grew up in Columbus, Ohio, and that was formative because there was the Ohio Supercomputing Center there and Ohio State University, which is how I first really got excited about computers and started working in sort of the Linux environments because we had very limited access to true Unix machines. But we did have some access. I had it through some friends of mine. And then when I went to college, and Frank and Eric and I all knew each other in college, I sort of brought some of my computer skills with me and was always excited about using computers to do all kinds of fun things. I was pretty amateur as a programmer. I did not know C. I knew some very sort of simple, basic, like literally the language basic. And then I learned MATLAB and a couple other simple things and kind of worked my way up that food chain slowly but surely. And I ended up with a degree in industrial engineering. And from there, I had been given guidance from my family to go into finance. And it was a bit of a weird transition because I would go to these finance interviews and talk to people and they would be like, wait, but you're an engineer. Like, you don't belong here. Like, that's not what we want. We want people that have this background and that background, which were alternative.
Well, what was the background they wanted?
Most of those interviews were around sales. So they were looking for people that had the sort of pedigree to go out and do investment banking sales. They weren't really looking for people to build systems, or at least the interviews that I encountered were not those interviews. I did get lucky enough to land one interview with a big bank and ended up working in finance and spent probably the first 6 years as a spreadsheet jockey of various kinds. And that was my expertise. I was quite good at it.
Is that a title that they have, spreadsheet jockey?
I think it's like a subtitle. I don't think it's ever a primary title.
Got it.
But
okay.
I saw some, and that we can get into this a little bit. I saw some pretty unbelievable spreadsheets. I mean, things that your head would explode.
Okay,
things that you could not imagine.
I'm going to answer for Mike here and say we do not want to get into that. Is that fair, Mike?
I would concur.
Yeah.
All right.
We've seen a lot of gnarly spreadsheets.
Yeah, so they're pretty gnarly, and people did some pretty amazing things. And I learned a bunch of skills around that. And that was basically, again, kind of getting more into programming. And then we can come back to talk about a couple stories about this. But I kind of had like this break where I had been working on some electronic market making, electronic systems, and through a spreadsheet. And I was asked to do this big trade, this big unwind trade. And in the process, they kind of were like, oh, this is legitimate. Like, this could be done out of a bank. And then I bumped around from place to place and ended up going to another firm and another firm and another firm. And at some point ended up kind of in the belly of the HFT beast, one of the largest high frequency trading firms in the world at a time where they were doing very well and really saw like what was happening on the inside. And it was really exciting and really fun. And we built a bunch of systems and we lost a bunch of money and we made a bunch of money. And we solved a bunch of really quirky and wild problems.
Can I jump in with a question? So
Sure.
You said I was asked to make a big trade, and then you also said we made a bunch of money, we lost a bunch of money. Can you kind of give us a sense for this big trade? Like, what are we talking about?
Okay.
We don't really have a capacity for this in our
Sure.
mindset.
So the big trade. So to give you a sense, what had happened with that big trade is Hurricane Katrina. So we had this. I was working doing execution for a bigger trading desk, and that big trading desk had a budget. They were trying to make $100 million that year. And it was a group of 8 of us, so like not many people. So the primary risk takers were putting on very large trades. And in the process, one of those trades went very badly because of Hurricane Katrina. And during that hurricane, the Fed said that they were going to cut rates. It changed interest rates. That whole area was in the fixed income part of investments. And because that thing unwound, I came in on Monday and everybody was called into an office and they basically said, these people are being let go. We're shutting down this group. We need to unwind all of the trades.
What does
One
that mean?
person.
Unwind the trade. Sorry, I'm pretty,
Yeah, no, it's okay.
pretty naive.
So in a process of making investments, you're going to buy a bunch of things. So you can buy a bunch of bonds or you can buy a bunch of futures. And in this case, it was a bunch of futures, which are investments that perform correlated with interest rates.
Are those always or usually associated with commodities, or in this case could be any stock? I mean, I usually think futures, you're talking, I don't know, oil, rice, grains,
sure,
stuff like
we
that.
can go way down that rabbit hole. But yeah, futures can be on any underlying product.
Okay.
So oil, frozen concentrated orange juice, bacon, pork bellies, wheat, all that stuff as futures. But there's also a whole market. And it's actually the biggest part of the futures market is based on interest rates. So it's a future that gets a bond delivered to it in that future date. So an oil future, you get oil delivered into it. In this case, it's a bond that is the delivered product.
Okay. So unwinding then means what in this case?
So we've got a bunch of investments. They've lost a bunch of money. And the senior people at the firm came in and said, we want you to get rid of all the positions and just give us cash at the end of the day. We want you to liquidate everything. So it was like being brought in to liquidate an office building or have an auction, right? Sell it all.
Mm-hmm. And
so
you
we
had
were
to do
basically
this
told
with your spreadsheet somehow you did this.
Yeah. So we were told to sell it all. And this was still a time where we would call up on the phone. So we'd pick up the phone. There would be a guy that was in the pit, a market maker. We would call them and say, I want to buy 2,000 red packs, which was 2,000 times $1 million times 4. So $4 billion. So that was like a $4 billion exposure to do 1,000 red packs. So there was a lot of these trades on. So to make millions of dollars on these things that move very small amounts, you end up with huge volumes that you're trying to trade. So the guy who was supposed to liquidate it started calling to the floor to do these sales. Well, what happens is when you start calling on the phone to sell, the guy at the other end of the phone realizes that every time they get your phone picked up, you're going to sell. So the price moves down, then the price moves down. So the price kept moving down every time he would pick up the phone. And he still had a lot to sell. So I was literally back to back to him. And he turns around to me and he's like, hey, does your spreadsheet work? I was like, yeah, it works. He's like, I need to sell 5,000 red packs.
From the spreadsheet.
Yeah. He was like, I want you to sell 5,000 spread. What was hilarious is that we had built this spreadsheet with all these limits on it, right? Like we didn't want to do something stupid. So it was like each order couldn't be more than 10 and the total day couldn't be more than 100. And the total, like all these risk limits we had in our system. We basically had to like reboot the whole system so that I could do 5,000. So that we started selling it.
And the spreadsheet issues API calls to the exchange?
Yeah, so it used to use something called RTD. I don't know if you guys remember RTD. Mike's nodding, so he's heard of it. It was basically a callback method. So there was an underlying library, and then in the spreadsheet, we would submit an order, and it would make a callback, and then that callback would go to this library. That library would then connect to the exchange. But this is like 2005.
Kind of mind-blowing to me. Mike, what do you think about this? Is this right in line with what you expected, or are you already like, wow?
It's a little bit out of line with what I was expecting, but I have seen the movie Trading Places, so I know quite a bit about futures trading.
See, there you go.
With Eddie
Exactly.
Murphy and Dan Aykroyd.
Yeah, that's a classic.
So that's what you watch when you start this job, Trading Places.
Yeah, they
That's your
put you in a
onboarding.
room. That's the onboarding, is Trading Places. Yeah.
So,
Pretty
Bob, it
much.
sounds like you sold millions of dollars, you unwound millions of dollars in trades from a spreadsheet, and you were like, "Well, this is fun. Let's go do this for full time." Is that what happened?
It didn't work. Not exactly. What happened was that was still the very, very early days of the CME, the Chicago Mercantile Exchange's electronic trading platform. And nobody really knew if it was useful. It was a parallel market that was running along with the pit market. And it was the first time I executed, and the people at that company at the time saw that you could do that. And they were kind of like, wow, this is really intriguing. You could do a lot more in that short amount of time than we thought. I wonder what else we could do. And that started to give more leeway to do more research and do more work to figure out what to build next. Now, they were unwinding all the trades because they were shutting down that group. We were liquidating all the assets. So it was a pretty short window that I did any more work in that area. But to me, it was really intriguing that, like, hey, this computer stuff might really apply to the trading area. And then it was a few years later that we really applied that to much more interesting problems.
I mean, calling people on the phone pretty much sucks, right? If you could write a program to do it, it's quite a lot better. But it sounds like in this case, the advantage is you're not dropping the every time he picks up the phone, you say the price drops, so you're kind of getting around that a little bit. You're sort of tricking the system a little bit, right?
Exactly. Yeah. I mean, you're not showing your hand. So when there's a human involved, the human often picks up on what the pattern is of what was going on. And it would work the other way around. When you were a market making desk, which meant you were providing prices out to customers, you would know that when customer X calls, when that line lights up, he's going to buy. So you would see the phone ring and you would start buying before anything else happened. You would just start buying because you would know that that guy is going to ask you, he's going to try to buy, he's going to ask you for an offer. And so you can get a little bit ahead of it by doing some buying in advance. And there were all these games that people would play around how to get around that.
There was a time when Eric and I were working with mutual funds, not directly, but through a company that did data for mutual funds. And as I recall, I can't remember if it was technically illegal, but people got pretty upset about that kind of front running.
Yeah.
Was that kind of behavior ever legislated against, or is it still something that happens?
It's definitely something that is not happening as abundantly anymore. There was a bunch of legislation that went through after the 2008 financial crisis where people were getting way ahead of the trades that were coming in from customers. And so now there's a bunch more regulation around showing that the trade you're doing matches the customer trade. But in the early 2000s, there was less regulation. There was less kind of keeping your eye on what was happening. And so it was much more common that people would do things like that, or they would do it in subtle ways. They would do it in different ways that they could. And often it was very like, the guy's going to come in and he's going to buy, $5 billion worth of swaps. You're just trying to get the first 10% done. Like, you just want to do 500 million of it. Like, you're like, look, I'm going to have a lot of trade to get done here. Can I just get 10% of it done before he comes in with the trade? Because as soon as he prints this trade, the market's going to go straight into the air and I'm going to have to be chasing it. So what can I do to get a little bit ahead of it? It wasn't I think he's going to come in, I'm just going to get way ahead of it and I'm going to try to make a bunch of money off of this tiny trade. It was, look, this is a big institutional fund and I got to do something to cover my butt. Otherwise, I'm going to be out of ton of money.
It was an efficiency gain that also happened to be beneficial in terms of earning more.
Yeah, you can think of it that way.
Can you tell us then about the transition to high frequency trading?
Sure.
Because that I hear stories about that, and it always sounds kind of mind boggling. The numbers, the speeds, what's actually happening.
So we bumped around. So I bumped around to a couple different shops before I ended up in Chicago. And at the time, most of the firms were based in Chicago, doing that kind of trading. And so high frequency trading, to really describe it, we kind of have to take a step back and talk about that market maker and that market maker activity. And the market maker I've been trying to think of good analogies, and none of them is quite great. The closest is going to be like the like online concert ticket resale business. So if you can imagine, like, there's a bunch of tickets, there's a finite number of tickets, but you could buy and sell those tickets all day long. If you think that on this, show, a new performer is going to be announced in the next week, you're going to buy a bunch of tickets. And then when they show up at Lollapalooza or whatever, you could sell all of those tickets. And you're going to make the difference between the price you buy at and the price you sell at. And if you think that you can deliver those tickets in the future by buying them at a lower price, you might sell the tickets before you have them. And then later, when the price goes down, because all these, Taylor Swift canceled, and so now the price is worth way less, you buy the ticket and you deliver it to the person. So there's a final delivery, but in the interim, you could make differences in the prices. In a perfect world, what a market maker wants is they want a price where they can buy and sell at two different prices, and they make that spread, the difference between the price they buy at and the price they sell at, and that the market doesn't move anywhere. So like the concert ticket stays at right about $100, and I buy at 99 and I sell at 101, and then I buy another at 99, I sell another at 101, I sell two at 101, I buy them back at 99, and now I'm making those $2. Every trade I'm making $2, $2, $2. And going back to trading places, that's exactly what everyone was doing in the pit with all those crazy hand signals. They were standing there and they were buying and selling frozen concentrated orange juice by taking the difference between the price where people want to buy and the price where people want to sell. Well, if I can compress the time that I'm holding that asset to almost zero, my probability of price changing is almost zero. And now I'm just bouncing back and forth from buying and selling to buying and selling. And this is where the high frequency part comes in. I want to make those turns as fast as possible. People have definitely tried, before it was electronic, people would try to do this in the pits. They would try to do it by having groups of people that sort of work together. So there would be groups in the pit that were all sort of on the same team. There would be like three guys, and they would all be sharing the same portfolio. And so if one guy got a good buy, they would pass the information to the other guys. Then one of them would sell, and they would offset that buy and sell against each other and have zero spread.
I think I got a little lost with the zero spread. I was going to ask,
not zero spread. Sorry, zero net position. They would have no concert tickets at the end. It's like I bought 100 concert tickets and I sold 100 concert tickets and I made the money.
Yeah, and I was kind of wondering if there's if there is sort of a margin where this is worth pursuing and where it's not worth pursuing, because you gave the example of $99 and $101.
Right.
Presumably it's worth a certain amount of effort. And then once you get below that threshold, it's like, it's not even worth it.
That's right.
There's sort of a percentage where it starts to become attractive. And maybe that percentage reduces based on how fast you're going. Is that what you're saying?
Yeah, how much you can turn it over. So there's a fixed fee for the infrastructure and the people, and maybe the exchange has some fixed fee. And then there's going to be a marginal fee. The same way that when you buy and sell a ticket online, you're paying some fee. So for the online ticket business, that would be a huge spread you would have to make, the difference, because you're paying such a big fee when you buy and sell. But in the financial markets, those fees can be very low. So like fractions of a cent per share. And so now when you're getting to fractions of a cent per share, you could trade a lot of volume and make a few $100s and make it with very little risk because you're turning those positions over very quickly.
Okay. So risk is another variable that comes into play here. If you're moving really fast, it reduces your risk because there's like fewer fluctuations, I guess. Is that right?
Exactly. So you end up with fewer fluctuations in price and a lower average inventory. So at any given price, if there is some announcement that moves the market a lot, your chance of holding a big position is relatively small.
So this is sort of the history of HFT. My head's already spinning a little bit. Mike, how you doing? You following all this stuff? Or maybe Mike has more background on it than I do.
I have a lot of questions.
Let's get some of them.
Well, I guess one thing that immediately occurs to me is that I assume that in most cases you have some sort of strategy, which means that you need to know the price of what you're buying or selling, but that thing changes. So I'm trying to figure out what the back and forth is between determining the price, placing the order, and making sure that the order gets executed at the price you had expected before things change.
That right there is kind of the nut of the whole thing. You've pretty much nailed what is the hardest and most important part, and is where the speed matters, and is where all the technology ends up getting built around.
Can we restate it for me to make sure I'm following? Mike,
sure. So what I
Go
heard
ahead.
Mike say was, you have to figure out where the market is, so where the price is, and then figure out how to turn that into an order that you send, and then confirm that that order is either in the market or has transacted.
And just to clarify, if the order goes in too late, the price you think it's going in at the order is wrong, right? Is that sort of subtly what's going on here?
Yeah. Is that right, Mike?
Yeah, that's pretty much it. I mean, I've seen this happen in the low frequency sense of, there's you can see how prices are moving, and you can put in, say, a limit order or something, and you know that it's going to be executed if it hits a certain price. But you're not doing this on a second by second basis. You're doing it, during the course of a day, maybe.
Yeah. Yeah. So we can break that down into a few pieces. The first piece is the market data piece, and then the second piece is the order submission piece. So there's like the incoming information and then the outgoing information. So I'll break it into those two parts first, and then we can dig deeper. That incoming information, what's really kind of funky is that the exchange, whatever the exchange, they care about what's happening at their matching engine. And their matching engine is the thing that says buy order A matches with sell order C. Those two people match, and now we pass the orders out. There's an offer to sell at this high price. There's a bid to buy at this low price. Someone comes to sell. They take the first bid. That person gets filled. Those two orders get spun out. This is the core in the sort of, it's like the center of the Death Star, right? You're all the way in the middle. Like, that's the thing that runs at the very middle of what's going on. But you're not allowed to touch that or see that, because that thing is running usually in some lockless environment. So it's just spinning perpetually, taking everything that's coming into it. And everything that's coming in has been queued somewhere in the past. And the data that it's spitting out is getting buffered somewhere and then getting broadcast out. Let's take the broadcast out part. So what they're going to do is, depending on the exchange and what they do, they'll either tell you, hey, this is the total amount available at this price, or some of them will say, we're going to tell you every single thing that comes off of this spinning core. But then you have to figure out how to process it. So they're going to turn that into this market data distribution network and start spinning it out at you, just pummeling you with data. And your job is to consume that data as quickly as you can, so that you have the best guess possible of what's at that core at a given time. And this is exactly what you're saying, Mike. Like, even if you do this, clicking on a web interface to sell some stocks so you can put a down payment on your house, the price you see there is not the price at the core of that exchange. It's delayed by all of these filters that go through. Even at the high frequency level, there's some delay between what you see and what's actually at the matching engine.
You're talking about you need to consume that data to understand what the market's at. Can you give us any, so I don't know, like order of magnitude, like how much data do you think we're talking about, I guess? I mean, if I'm in a trading, maybe I'm only trading a certain portion of the market, it makes my job a little bit easier. And you got to consume it as quickly as possible. Do you have any kind of numbers or idea that you can help us ground this a little bit?
I don't. I have to go look that up. I do remember, as an aside, I do remember for the flash crash. If you remember, there was like a flash crash event. I was working at this large firm at that time, and we got a phone call, just to give you a scale of like the data. We got a phone call from the SEC, and they said there's a 2-hour window between this timestamp and this timestamp. We want to know every order you sent and basically like all your logs, but all your like outgoing logs of everything that was sent. We were like, okay, we have that. Like we stored it, no problem. And then we were on the phone call with them and we said, how do you want us to send that to you? And they said, oh, you can just email it to us. And he said, it's 8 terabytes. And they kind of dropped the mic at that point. Like they did not understand what scale we were operating at. They were floored that in 2 hours we had 8 terabytes of outgoing messages. That was just our outgoing messages. That wasn't even our.
Each one of those messages is an order?
Each one of those messages is either an order or a cancel.
Got it. 8 terabytes.
So we either said, I want to buy there. Nope, cancel it. No, I want it. I want to cancel it. No, I want it. No, I want to cancel it.
Wow, that's amazing.
When you're getting this fire hose of market data, is that arriving at a computer that's like co-located with the exchange?
Yeah. So yes, it is. So co-location, we can go down a deep, deep rabbit hole here too. And there's a couple entertaining stories about it. But when we talk about all of this trading at this high frequency, you really want to be as close to the server as you possibly can be, their server, as they will allow. Different exchanges have different sets of rules. Some of them say the data center available is across the street from our data center. Other ones say you can be in our data center. You can be, what rack do you want? Where do you want your server? Often if you come in, or this is the olden days, I don't know if it's changed, but in the olden days, you could come in and say, hey, I want to take down 4 racks. Can I have the 4 racks as close to the exchange as possible? And they would say, well, 4 racks, sure. You can rent those ones and they can be over here. They can be over there. There was actually a time where they changed a set of rules because some people realized that certain racks had shorter wires to the exchange than others. And you could figure that out by looking at your exchange timestamps and your order submission timestamps and then say, oh, this rack is further but has a shorter wire. This one's closer but has a longer wire. Because the people who set up data centers very rarely are thinking about inter-cage connectivity performance until you tell them, oh, I want all my server. Right? When you call them on the phone, you say, I want everything in cage 4. And they're like, you've got 300 boxes. Like, why do you want them all in cage 4? Just move them all to cage 4. Re-rack everything in cage 4. Like, they start asking questions, you start asking questions, and it ends up coming out what's going on, and then they reconfigure everything they're doing.
It reminds me of when you go to SeaWorld and they have the colors of the seats that you can sit in based on how wet you'll get. So it seems like for high frequency trading, you want the darkest blue, the biggest splash zone.
You want the biggest splash zone
seats. You want to get really wet.
So those servers are co-located. And then to just answer a question you haven't asked yet, which is, do you want one box decoding and broadcasting, or do you want one box decoding, deciding, and sending an order? That's a big trade-off, possible big trade-off. And this is where you get into a lot of complicated networking about, if I have one box decoding and broadcasting on my rack level network, and it's got to go up to the switch and then back to the box that's making the decision, is that better or worse than doing the decoding on my box and having a dedicated core that's just decoding market data? There's a trade-off between those two. It depends on the type of trade. It depends on the scale of the trade and like what you're trying to get done.
When you say one box too, in my head, I'm hoping there's multiple boxes, because if that one box goes down,
Yeah, everything is redundant. Everything has multiple backups of everything you can imagine.
Can you tell us a little bit about the software, the operating systems that run on these things? Is it just Linux, but maybe these things are written in C or a language like that?
Yeah, so it's almost all Linux. There's every firm that was serious that I worked at had somebody basically hacked the kernel, was a full-time kernel hacker. All the networking had kernel bypass. So it basically went straight through the networking card into a known memory space. There was a lot of speed ups that people took advantage of. So they were Linux, but they were usually a customized version of Linux in one way or another to make things run as fast as they could run. And then the code was almost exclusively C code, but there's a whole other game about when you write that, how you write that to be performant, and then how do you modify it. So to go down to, it looks like Mike has a question.
Mike has a lot of questions. Let's go back to Mike.
One question is, do companies make hardware specifically for this application, or is everything kind of custom?
That's a good question. So in the time that I was most involved in it, and that was almost 10 years ago, where I was, up to my eyeballs, was it tended to be off-the-shelf hardware, but usually put together according to whatever spec. And the one exception to that was the networking was almost always using an FPGA card for data decoding, so that the network packet would come in, hit the FPGA card, and the FPGA card would decode the entire packet at once instead of serially going through that UDP message. So that was the pretty important custom thing that you would build. And there were ways that you could also build things for the outbound message similarly on an FPGA. I have not seen anyone go with an ASIC solution. And the reason that I've concluded is the exchanges are always changing a little bit what they're doing. And at any given date, they could come out with a release and say, oh, we're changing our protocol. You don't put a bit here, now you put the bit there. You move this from here to there. We're changing this thing. And you need to be in an environment where you can adapt to that. So if you printed an ASIC and put it on the card, which does this data decoding, on any given day, it could be totally out of date and unusable. And now you've got 100 servers at this co-location and you can't use them.
Do companies try to sort of, what's the word I want? Do they try to optimize the networking to the extent of, eliminating bothersome things like encryption and stuff like that, or are there like compliance things that you have to do to participate?
There's a very minimal, again, back in the day, there was a very minimal amount of compliance you had to have. It was usually around risk checking. So you had to know whether your order would put you past your risk limits for a particular trader or market or date or whatever.
That's not exchange, though. That's like the company you work for.
That's usually the company you worked for. But the extent of networking optimization was extreme. Going through and buying 10 different switches, switch types and switch companies, and figuring out which switch that one's 1 micro. That one's 2.5 micros. Okay, we'll take the 1 micro switch, buy 10 of those. All right, which this, which that. Like every single component, like no firewall. So you're in the data center. So there was like no firewall. There was no like anything you could do to avoid slowing down that message in and out was done.
So you guys are like Formula One networking hackers.
Yes. And even more extreme, again, at that time, the long haul connectivity was where you really got the speed up.
What do you mean long haul connectivity?
So long haul. So where are these servers located? Right? Geographically, there's a set of servers that's controlled by the Chicago Mercantile Exchange, the CME. Those are located in Aurora, Illinois. They trade a certain subset of products. There's a different set of servers that are located in various places in New Jersey. Most prominently, Carteret, Weehawken used to be a location, I don't know if it still is, and Mahwah, New Jersey. So if you're doing a transaction that interacts between those two, you need to get a message from Aurora to Carteret. That's a long way.
Yeah, ping time is going to be probably at least, 20, 50 milliseconds?
Yeah, I think it's, I'll have to look up exactly what it is, but you can calculate exactly what it is. You can calculate what the optimal speed of light speed is. And then everybody talks about how far are you from speed of light. And what happened towards the end of my involvement in that is that everyone went to microwave connectivity. So you ended up buying microwave towers that did hops between each location and went over the Appalachian Mountains and took you directly from Aurora to Carteret.
Wow.
That got you as close to speed of light as possible, as long as all that switching was right. But before that, before anybody even knew about those things, you could sit down as a networking engineer and say, okay, Verizon has a line that goes from here to here, and this other carrier has a line that goes from here to here, and this one, when it gets to Pittsburgh, it goes outside of the city and then comes back. And then it goes across over to this other look, and you could literally map exactly every line. And if you did that, you could take a millisecond off of your time. You could be the fastest person because you had paid for this small networking hop that went through the middle of Pittsburgh instead of around the outside, right? That got you from here to there as quickly as possible, or whatever the location would be.
You had a really nice distinction between data coming in, parsing it, analyzing it, and then orders going out, orders, buy or cancels or something like that. And I was curious what the scale we're talking about for time transactions here. We're talking microseconds, it sounds like.
Yeah. So on your box. So there's lots of things you can control. You can control your networking. You can control your connectivity to the exchange. You can control a certain amount of those components, and that's where most of the time is spent. But the thing you can control most effectively is what you would call the tick to trade time. When it hits the NIC card, I do all my processing and I send an order out. So into out time on the same box. Let's assume we're on a single box. The tick appears that says buy, and then I send that out. To be competitive, you really are single digit micros. I think there's people that are significantly faster than that and talk about cutting off nanos to make those things work at this point. There's definitely people that were starting when I was moving on that were doing this all in that hardware card. That FPGA card was doing the whole process. It would come in, it would decode and send out without ever hitting a CPU. And then it would report back to the CPU on the box, hey, I did this trade. Hey, I sent this thing out. And you would kind of clean up after it. So that would be a full hardware trade, and that would be less than a micro.
Jeez. I want to get to Mike's other question here, and then I have a question about, like, if I wanted to have some strategy, how would I deploy it? But let's see what Mike, you had another question you wanted to get in first.
I've kind of forgotten it.
Sorry.
I guess I was going to ask.
You were talking about sending stuff out at one point, which I did want to get to, if I can, which is that once you've made that decision about doing the trade, now you've got to get that order out the door. So you've made this one, you've in 5 micros, you've decided you want to send an order out. That order now has to get packaged up, usually in this fixed protocol or binary protocol. The fastest exchanges just ask you to write it in binary and send them the binary message. Other exchanges had different solutions. And then that order gets sent out and ends up getting queued at like the bouncer outside of the nightclub. Like they get lined up. So you get to that exchange and it gets lined up, and then it eventually makes its way back to that matching engine. And then you get another market data message that says, hey, my order is now live where it exists.
Did these things get stored on databases in the meantime? So, like, I send out an order, I need to track it when the message comes back in, or is it all in memory? Like, hey, I sent out this order.
It's all in memory. Oh. Everything is memory, and it's a lot of like level 1, level 2, like how much, like as small a thing as I can possibly keep around to persist what's going on. Eventually, everything gets written to a database because there's a whole second set of systems that's called order confirmation or trade confirmation, which is a separate universe and a separate thread that comes out of the exchange, and then that has to match up with the orders that you sent. So you send the orders and they get filled, and I'm running it real time, getting them filled, and maybe 10 minutes later, these orders get published on a separate channel, and then I have a whole group of people that reconcile those two continuously and say, well, what you think you traded is what you actually traded.
And then eventually, like you said, your goal is to have zero position in anything. So you really don't want to hold anything for longer than, I don't know how long you're talking, seconds, hours, days, weeks.
Yeah, seconds, fractions of a second. I mean, if you can hold it for less than a second and be in the front of the line at the beginning and the end, that's really optimal, right? Because you're at the front of the line. The trick to the whole thing is being at the front of the line. Like, how do I get to the front of the line? And how do I cancel my order as fast as possible?
What about at the end of the day when they shut the lights off? You get an order in, whoops, they close the doors. I'm stuck holding this thing all night. Does that happen or no? Is there
you usually get stuck with a little small something at the end of the day. But that small something usually net cancels, and there's ways to hedge it in aftermarket, after hour markets if you need to.
So you didn't really ever had barrels of oil delivered to the office, is what you're saying?
We never had barrels of oil delivered to the office. No. The most interesting delivery I ever got is I was trading currencies, and we were working through a bank that would offer basically their name for our trading. So we would trade, but we would be trading on behalf of this bank. We would pay them for that service. And in the process, by default, they would generate paper confirmations for the trades. And no one told them to turn that off. And I got a phone call that said, hey, Bob, you have a delivery. And I was like, wait, what? And they said, it was literally a pallet of paper. They had printed all of the trade confirmations, and they were delivering a pallet filled with paper of all the trades because the policy said do that. And I immediately called and said, cancel all of our paper trade. We don't need paper confirmations.
So I guess the thing that I'm still, and we probably have skipped over a lot. So you've got this FPGA. It's doing all of the logic of, I want to make trades. I want to buy. I want to sell. I want to cancel. But there are strategies that go into this. And so how do we deploy a strategy? How do I update that thing and say, hey, there's something happening I'm anticipating news about? I don't even know. Maybe this is a naive question potentially, but you see what I mean? Like maybe the bank wants to take a position in rice, How do you actually deploy that what's it look like to do that?
So I've never done that at the FPGA level. So I don't know how it's done at the fastest level. But at a slower level, which is still quite fast, the way that it tends to be done is you have an internal language of some kind, and different firms have different languages that they use that allow you to deal with some primitives, and those primitives are then what execute the orders in the market. So as the trader executing a trade, let's say it's rice. Let's say I want to market make in rice or wheat, some grain.
Not wheat, because I have celiac disease.
Okay,
let's stick to rice.
All right, let's say rice. Let's say there's a rice. I don't even know if there's a rice futures market. I'm going to assume that there is.
We could do corn. Corn's okay for me.
All right, corn. So we're going to do corn. So I've got the future market in corn, and I want to be making markets. And this is an interesting element that distinguishes what's going on inside these firms. There tends to be a group of people called a core developer. The core developer tends to generate this library, often in C, that gives you primitives that hook into it around sending orders in. Then in any particular group, there's usually a developer that's dedicated to that group. So we'd be in the commodities group, the three of us. And Eric, you would be the commodities embedded developer. And what you would do is, me and Mike would say, hey, we want to do this thing with rice where when corn prices go up, we want to buy rice. And
when corn prices go up, we want to buy rice.
Right. We think that when any grain goes up, all grains go up.
Okay, all right. So that's our strategy.
We want to keep, that's our strategy at a very simple level. If that's our strategy at a very simple level, then we come back and say, okay, well, here's what we need. We need the input, the wheat input, and then we need to get this rice output. And depending on the sophistication of the firm, there were places I was at where all those tools were exposed to me at a trader level. And with a pretty simple amount of programming, I could code that up. There was either a GUI interface or there was some very simple internal language that I could use where I could say, give me the wheat price. If the change in wheat price is greater than X, then make this rice order, place it here, cancel on this event, blah, 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 blah. I code up all of this scenario and then I hit submit. And what that does is it turns my high level code into low level code using that API and those set of primitives, and then deploys that onto the server. And if there's things that I can't do or that don't work for me or that I want to change, I go to Eric, our embedded developer, and say, hey, I need your help. This is only telling me about the top price, the first price in wheat, but I want to know the 5 prices in wheat. Can we redeploy this code in some way so I can see all 5 prices? And you'd say, yeah, we'll figure that out.
I imagine it gets a little more sophisticated than that too, right? Because you're probably looking at the rate of change of the price, things like that. So you could probably go pretty gnarly in terms of the math you want to throw at these problems.
Yes, there's a whole nother side, which is the math side of how do you model prices and how do you forecast prices. And often what you'll do is you'll do pretty sophisticated offline data center modeling. And then you'll come back and say, hey, what I really want to do is this complicated thing, but we only have 2 micros to do this whole turnaround, which gives me half a micro to do the computation. And it's a 1-second computation. So what are we going to do? What do we drop? What do we care about? And that's where there's this tight embedding between the person who did the research and the person who's doing the deployment, so that that person doing the deployment cuts out the right parts and doesn't cut out the important part.
It seems like it'd be easy for me as a developer to be like, oh, whoops, I plugged in this, complicated calculation. It takes so long, and now suddenly my trade's not even going to work. But
that's right.
There must be some evaluation to see this takes too long. You can't deploy it. Something like that.
Yeah, you usually have like a ceiling of what you can get done, and like, okay, I can't do it in that time. And then you kick it back to the researcher and say, hey, do it in this way. There was another pattern that I saw that happened again and again, which I quite liked, which was that a researcher would build a whole setup, usually in a language like Python, in a very simplistic way, and say, okay, this is the data, this is my reading, this is my processing, this is the order, this is a whole simulation framework, maybe provided or built on by hand, that's done in one way. They would come back and say, this is viable. We want to try this. Okay, whatever this testing, there's usually some conversation about it. Then that whole set of code had to get reported into C so that it could get run. And often we would find a bunch of errors in that process. So like you would go and say, okay, I want to take this price, I want to take this thing, I want to put these 2 numbers together and come up with an output. And then when you went to do it in C off of the real market data, not this processed market data, the developer there would look at you and say, oh yeah, you don't have that number. Like that's not available. That's only available after we process and publish. You can't know that at this time. And then you would rework what you were doing. So often having a replication of it was a benefit. It took more time, but it was a benefit to knowing what you deployed made sense.
What kind of bugs showed up because something, you deploy a thing and it behaved in a surprising way? Do you have any examples of that?
There were lots of bugs. The most common one that I saw, which was difficult to deal with, was it's hard. So when you're pulling data off of an exchange, historical data, that data does not have your participation in it because it's historical. It's replaying things that have already happened. When you go to deploy your actual strategy, you might place an order, and your placement of order changes the market data, which changes the signal, which causes you to make a decision, which is sometimes to cancel the order. So the bug that would often appear would be in markets that were thin, not many participants. You would turn on your strategy, and immediately it would be like, place, cancel, place, cancel, place, cancel, place, cancel, place, cancel, place, cancel, place, cancel. And usually you would have a limiter on it that would say, hey, if you've placed and canceled more than X in Y time, shut down. And so you would hit the button to turn it on, and it would immediately say 10,000 orders, and it would turn itself off. You'd be like, wait, what happened? And you wouldn't have, it's hard to forecast what you will do when these real things get published in the market data. That was
That sounds similar, Mike, to what happens with machine learning, where you're using your model outputs as feeding an input back into the model. Is there a name for that? I can't remember.
Self-fulfilling prophecy. When you're doing forecasting, are you looking, so say you're doing price forecasting, do you forecast like 10 seconds into the future? Or are you doing longer term forecasts and trading against what you hope to be trends?
Very rarely are you trying to forecast trends. When you're doing a market making, high frequency type strategy, you're mostly trying to figure out when there's going to be a permanent future price change. So you're okay with small price changes that then come back to the same market. What you really don't want is where the market moves up and then it moves up again, like in that sense, like a trend. But you're literally looking at like single tick involvement movements. And that whole forecasting process and how you pick horizons and what you think about is a black art of data science. Like, what do you pick and why makes a big difference in the outputs that you generate. And there's many different sort of opinions about how to do it. But, to forecast 10 minutes out would be way too far. Like, that's way longer than anybody's thinking about these market making style strategies.
So are the things that you have to correlate against other prices of other things?
Yeah, usually it's the dynamics of the current product and the dynamics of related products is usually the way that you tie things together.
It sounds a little bit like you're sitting at a poker table, and then instead of sitting at the poker table one day, you just put a computer in your place, and you make the computer sit at the poker table. The computer's kind of eyeing everybody else suspiciously, and then suddenly it's all computers at the poker table.
Yeah.
What's a volume of market movement you think that, or maybe movement's the wrong term, but how many trades do you think on any given day are done by this type of high frequency trading? Would you have a guess for that?
I would say greater than half. More than 50% of the total transactions are done in this way, because they're constantly placing and canceling orders, and they're trying to always be as tight as possible, as much as possible without canceling. And to do that, they're going to get lots of trades and do lots of offsetting trades. But if I told you that, Eric, you can do this, but you're always going to be in second place on every order, you will always lose money.
Why again? Can you help me with that?
Sure. So what's going to happen is if I tell you, okay, they're going to come in and there's going to be an offer. Again, let's take like the ticket example. If every time someone wanted to sell the ticket to the Taylor Swift concert in San Diego, you were always second in line. You were never the guy who was first in line. You would never get to sell a ticket because you'd always be second. Mike would come in and say, I'm a Swiftie. I want to go to the show. He'd go to buy the ticket. You would never get filled. You would only get filled when like 30 people came in to buy. And when 30 people all come in to buy at the same time, that's because the price is too low.
If I work at one of these high frequency trading firms, what do you think the volume in dollars they're trading in a day algorithmically is?
Billions of dollars.
Every day.
Every single day. So again, let's say that you shrink, right? If we're shrinking this time scale down and increasing this turnover, and we're making the spread on average, it means that you can get thousands of trades in one strategy in one day. And if you've got a 51% probability of being right, that's going to be profitable. And so because you can do so much volume in such a short time, that strategy every day will look profitable.
Billions of dollars in volume traded. What are our profit and loss numbers? What are the possibilities that you've seen in those? How big
in the high frequency trading? I mean, I've seen millions of dollars swings easily in a day.
In a day. So
That's not crazy.
I might not know what I'm doing. I deploy something. I might lose millions of dollars in a day, and that's just a regular day at the office. So that's like,
No, not a
okay,
single guy
all
at a
right,
firm level. So
okay,
as
all
a
right.
single guy, so let's say, Eric, let's say you came to the firm and we started a trading firm and I had you trade
And I'm pretty clueless. So you've
and
already
you're
made a
pretty
terrible
clueless.
decision. Terrible decision.
I'm going to put you on a really small limit of risk and I'm going to put you in a really small strategy. But again, because you can turn over hundreds of possible trades, you're going to know really quickly if what you're doing makes any sense at all before you're going to lose thousands of dollars. And the
Okay.
things that work, you're going to amplify. And the things that don't work, you're going to shut down.
Can you give me a sense too? Like, let's say I build a thing and it seems like it's working. I go to work. It's a good day at work. How long do I sort of ride the coattails of that thing? The next day at work is already that strategy that I built is already out of date because the market knows about it. I mean,
Yeah.
every day I need a new thing to deploy, or is it like, I build this thing that can adjust and adapt. It's very sophisticated. Maybe it's using FFTs. That's what I want to insert in there.
um, at one point I tracked like the different strategies that I was running in a group that I worked at, and I had really good statistics around performance and new idea trials. And if I can remember, I'm pulling from my memory on this one, but I think my statistic was about 1 to 2% of new ideas worked. So for every 100 strategies I tried, and a new strategy could be I tweak one thing, I deploy. I tweak another thing, I deploy another one. I tweak it, and I could run 5 of them at very low risk simultaneously and
Okay.
see what's going on.
All throughout like one day.
So,
Like I'm just
so all
just
throughout one
trying.
day, I might deploy 5 to 10, and I might have a group of 10 people. So we might deploy 100 in a day. And out of that 100, 1 or 2 were viable. I remember that there was, as you would expect, like anything, there was this big long tail Poisson distribution. So like most things survived for a month to 6 weeks before they eventually got killed or replaced by a small tweak. And there was a few that lasted for a year. They just kept running. Like every day you'd come in, it would make a little money, it would make a little money, it would make a little money. And you didn't always know exactly why. There was a little bit of black art in the whole thing. Like there was a little bit of magic of the way this thing works in this infrastructure. And I guess as an aside, I had this experience repeatedly where people would come from other organizations into our organization and would say, hey, I did X, it works well, I'm going to build it from scratch. And no matter how much they banged against it, they could never get it to work. There was something about the other organization's infrastructure, setup, risk system, whatever, that made it work there that is not transferable. The people who are really, really good in this business, they usually are starting from scratch again and again. They come into a new place and say, hey, what works here? What makes sense? What do I know? How do I adapt? How do I deploy? And then they figure that game out and they play that game.
I was almost imagining it'd be pretty stressful to come up with new strategies every single day, but it does sound like you can sort of tweak an idea over a period of months and see
Yeah.
how it's getting better or worse.
Yeah.
I have sort of a philosophical question, I guess, which you can avoid answering if you'd like. I've heard mixed opinions on the benefit to society of high frequency trading. Some people say that it optimizes market efficiency, and so it's a good thing. Other people say it allows people who are already rich to get richer because it's you have to have this high level of access to even participate. What's your take on that idea?
It's a fair question. I definitely have a few strong opinions around it. The first one is if we go back to the 1987 Black Monday stock market crash, where it was all people at the New York Stock Exchange on the floor and things were falling apart, people just said, I'm not giving you a price. You want to sell that, but I'm not buying. And they just put their hands down and said, we're not trading. I don't want your risk anymore. I'm not willing to take it. That's a pretty bad outcome. Like to have no one take any risk at any price is a pretty negative outcome. The movement to electronic markets in general has added a lot more participants that are pretty sophisticated who are willing to take prices most all the time, even when things are bonkers. So again, going back to the flash crash, which was not a 1987 level, but it was pretty scary. There were still a lot of markets a lot of the time coming from those players. So the question is like, when again, if you go into your online trading account and you're like, okay, today's the day I'm closing on my house, I need to sell these shares of Costco so I can make my down payment. You expect there to be a price there. Like no matter what day of the week it is, no matter what's going on, you want to show up and say, okay, I need a price where I can sell this. Even if there's a financial crisis going on, even if the Fed is going crazy, no matter what, you're closing on a house, you need the cash. In general, it seems that this moving to electronic market making and moving to continuous electronic market making has provided a lot more liquidity for what we call people that have this immediacy. So they're providing a market where you can immediately buy or immediately sell. And in return, you're paying some fee, right? You're paying that spread between a bid and an ask. If you want to place an order at a set price, that's a limit price, and you're always able to do that, and it goes into the queue and it gets transacted against with other participants. So do you need a bunch of capital to get involved in this business? Absolutely. And the numbers just get bigger and bigger. But did you need a lot of capital to be the market maker on the floor of the exchange? Oh yeah, there was a ton of capital requirement there too, from buying your badge and your seat to capital deployment and so on. And those people were making the same profits, but to get involved in that club was even harder than getting involved in the electronic club. I guess that's been my sort of abstract take on the whole thing.
Are the opportunities for long-term investing, the famous Warren Buffett type of strategy, is that limited now because of high frequency trading? Or does that
No,
that's
I would say that
orthogonal?
those are totally different. Those are complete polar opposites. So if you're making long-term investments, you want to get your trade done at a fair price, right? And whether I think that I think it's a Warren Buffett quote. It was either Warren or Charlie Munger that said something to the effect of, "I don't care if the stock market is closed tomorrow or for the next week. It doesn't make any difference in what I'm doing." Like to them, whether it's open or closed doesn't matter. They're not trying to turn positions over at all. They're trying to make investments and hold them for a long time. They want to get fair prices, but they're not expecting, really quick turnover of anything. And they're investing at this point really huge amounts of money, so you couldn't turn it over fast.
Do you have any stories from your time doing this that would be surprising to software developers like Mike and I to hear?
Yeah,
what
I
it's
have a
like?
good one.
All
I
right.
think.
All right.
All right. So this one is just was it was just such an amazing experience to us. But I was working at one of these firms, and we were trading in the currency markets. And the currency markets have all kinds of weird things that they do. But one thing that was going on is that we were on this one exchange, and we were talking with the primary developer of that exchange. We asked them about what was going on, and he told us that they had chosen to write their gateways where the orders are submitted in Java. And we were like, oh, okay. And then we thought about that. And then we asked them some more questions, and they were telling us about that. And that was kind of unique at the time. Most people were in C or C++. But those were in Java. And then we got back, and we were talking with one of our embedded developers, and he was like, I've got an idea. Can we pull some data? And we started pulling the data and looking at it. What we found is that, as you know, Java has the Java virtual machine. And the Java virtual machine has a policy about deciding when to compile. Because if you make a function call enough times, the JVM says, oh my God, this guy always wants to know this thing. I'm just going to compile this, and I'm going to have it available so that we can queue it.
Like a JIT, just-in-time compilation?
That's right.
Is that right, Mike? Is that the right word to use there, or is it not applicable in space?
Just in time. Yeah.
And so what we discovered was that if you went to this gateway and you just tried to send in orders like at a regular frequency, they would be really delayed passing through because they were never compiled. But if when the exchange turned on, you went to that connection and you just went and you hammered it with orders, totally nonsense orders, you just hammered it, it would go, oh, geez, these guys really, I have to compile this. And they would compile it. And then every order you sent after that at whatever frequency would just go straight through. And so this is one of those things where like this decision about Java was made for lots of reasons, none of which had to do with thinking about performance, and for which, as the participant, you could figure out a way to play a game that was to your advantage. And I just think that that's an interesting, the people who are building those technologies are not thinking, like, they don't start and say, oh, well, because of JIT, we probably shouldn't do this in Java. We should do it in something else. Like, it would never cross anyone's mind as a developer that would be the constraint.
Well, I would have thought, based on what you've said so far, you wouldn't want garbage collection pauses. That's the first thing I would have imagined.
Yeah, we track those too. We could, so from the data that comes off of these connectivity, you could check all of those things. I could see when my order went through. I could see what speed it came back at. I could see when garbage collection kicked in on this gateway, but not on that gateway. Wow. I could reroute my orders because I could see I just sent an order, but it took the 99th percentile time is way longer than it should have been. Switch gateways on my next order that goes out the door. And you could do all of that dynamically on the order sending side. So that was a story that was like always really fun to remember.
You didn't have any control over the configuration of the JVM, though. You were just inferring all this stuff as a sort of from the information that came off of it.
Yeah, we couldn't touch that JVM at all. We were sending a message to that gateway and could make decisions about whether we wanted to send a message or not, but we couldn't move other things around. So
you must have collected a huge amount of data to analyze after the fact too, like huge amounts of data where you're doing all kinds of performance analysis and other things.
Yeah, that was very common to collect massive amounts of data. And often we would try to collect that data when we could at the packet level, because there were other situations where something would get messed up at the packet, or I want to know exactly what UDP packet was sent to me at what timestamp on the hardware, and then figure out why my order didn't get filled. There was a bunch of times where we would try to figure that out.
So I have one other question, but let me kick it over to Mike. Mike, did you have any other questions you wanted to raise for Bob here while we have him?
Could you give us a sense of what the hardware looked like at the time that you were involved in this? I ask because I have this sort of hobby-like interest in Linux schedulers, and they've gotten more and more complicated as the CPUs have gotten more and more cores, and so I'm kind of curious to know what the actual CPU looked like in the time at which you were doing this.
Yeah, I think that at the time, I remember most distinctly we were on the upgrade cycle with Intel, and the last one I remember, I think, was Sandy Bridge. I can't remember which generation that was exactly, but at one point we did end up with a bunch of different cores, and there was a whole internal debate about the routing, like how certain, I believe this is true. Mike, you and Eric, you might know this far better than me, but I believe there was a situation where the processor would start computing things before you finished your request on the instruction, and then it would like have half or pre-computed things, which you wouldn't totally, so you couldn't totally control, like, I'm sending this instruction, I want this answer. You would say, I start sending this instruction, and it would start taking stuff and computing before you had finished the instruction so that it could give you an answer, quote, faster, but then that would occupy the cores. I don't know if that's the detail you're trying to remember, but there were things like that that were really funky that I don't know if at that firm we ever mastered, but yeah, there was a lot of sort of always being on the latest processor, always being on the newest version of everything.
Yeah, that conditional execution type of stuff has
Yeah, that's what
been
it was
around
called.
for a while. And I've been seeing now that there are some cores that are sort of like warmed up and ready to go, and other cores
Yeah.
that are, trying to use less energy so they don't necessarily get scheduled to as frequently. And so I
The
just,
thing I remember was there was a push at one point to buy overclocked machines with large L1 caches. So there was a whole design difference when you said, if I've got a really big memory cache right next to the CPU and I can overclock this thing and run it at a higher speed, then what can I get out of this in terms of performance and in terms of decoding time and in terms of analysis time? And there was a whole debate, I remember at one point with one exchange where we had to like, they didn't want us to put a liquid cooled box in their rack because they were worried that if something went wrong, it would leak, and the liquid cooled leaking would hit all the boxes below, which might not be ours. And there was this whole back and forth around how do you get an overclocked server into this location with these, what are the requirements, where can we do it? And we had to go around in a bunch of circles to figure that out. But yeah, that's what I remember. That hardware specification stuff was never totally my world. It was most likely, I would just say, give me the newest, fastest thing we've got, and let's just figure that out. I was more in the to use the F1 analysis. I was more in like the driving the car part. So I knew the car went fast, and I knew those things had been tuned. And sometimes I would say, okay, downward force has to be a little different here. This thing has to be a little bit different there. When I turn right, the brakes don't work exactly right. Fix it. But it was very rare that I was like the guy that was actually fixing that level in that part of my career.
cool.
What was hard for you, Bob? What was the hardest stuff you ever had to do in this type of role?
Hard technically, hard emotionally,
Either.
hard
So if it was
psychologically.
stressful, yeah, any of that.
I
Like,
think
what made the job? What's the difficult part of this job?
there's two difficult parts of this job that come to mind immediately. The first one is you are dealing with very large amounts of money very quickly. And there were days that I remember coming home and telling Janine, my wife, and being like, I lost a whole house worth of money today. Like a whole home is gone.
But the
Like,
company's got a lot. It won't even.
I know the company's got a lot, but it's easy to take it really personally, and it's easy to be really stressed out about it. And the second thing that's really stressful, and we didn't mention this exactly, there's something called cancel on disconnect. So you can go to the exchange and say, look, if my server dies and you don't hear from me for X amount of time, and you don't get a heartbeat, cancel all my orders. And it saves your butt, because inevitably there were times where, for whatever reason, tech reason, power reason, something, you play the game long enough, eventually something goes wrong. And when that something goes wrong, it's very, very stressful, because suddenly, usually we would have that heartbeat would give us a red on our screen. The whole screen goes red. Every server everywhere has disconnected. And it's, 10 a.m. and you've got millions of dollars of risk on. And now you don't know your position. You don't know when you're going to reconnect. You don't know if your orders got canceled. You don't know what's going to happen. And now you're just in like, fight or flight mode. Like your body just goes into this, like, what do I do now? Like, I've got to deal with this somehow. Mm-hmm. How do I deal with it? That was very stressful. And the whole times that the market is open, you've got to be on. You've got to be playing the game. You can't go to a meeting. You can't. And then there were people who were like, they couldn't go to the bathroom. There was literally people that, like, from the time of the open to the close, they would not leave their seat. They would be in their chair the whole time. Right? I can't leave my seat. There's just too much. There's too many things happening. I mean, I could be running 250 strategies simultaneously. I'm watching all of them. I'm keeping my eye on everything that's going. I'm expecting all these numbers to be about like this. And when something goes wrong, you want to catch it as early as you can. So you're really, really on it. And that's like a really stressful thing. That's one big element of stress. And the second big element of stress was, by technically speaking, like when things stop working and you don't know why. Making money, I'm making money, I'm making money. This stuff's working great. Everything's fine. And then I come in on a Monday and nothing works. Nothing's making money. You don't know why. You don't know what changed. And then you start trying to, it's like a debug, but it's a debug on the money clock, right? It's like
we're losing
leaving
money the whole time. I'm trying to figure this out.
I'm debugging, but I'm running this EC2 instance or 100 of them. And it's like every minute that I don't figure this out, I'm losing money. Like this is just burning money. Like, when are we going to figure this out? What if something changed that we can't fix? It's like outside of our domain. A new competitor came in, a new event changed, a new whatever happened. That was extremely stressful too. So like those two things were really taxing on the adrenals.
So if I were going to take this job, I'd pretty much need to wear a diaper because I got to go, I'm going to drink like 3 cups of coffee in the morning. I'm going to go to the bathroom probably 4 times, between the beginning of the morning and middle of the day. And I can't sit in my chair the whole time.
We got better as time went on. We got better at saying like, hey, you bring up this controller, watch what's going on. I'm going to this meeting. I'm doing this thing. So we got better at it. But yeah, maybe diaper's a good idea.
Here's my last question. Mike and I, let's say we want to start a business and we're like, wow, this sounds fun. Let's do this. Can you talk us out of it?
Yeah, I think that would be pretty easy to talk you out of it. I think so. You want to do this. You want to set it up. The road to get there will be long and expensive. Those are the first 2 things to realize, is that you need to start by saying, okay, I've already got this expertise. You need somebody, you're best off by paying to hire somebody that knows the ins and outs of how it works, if you can. Mm-hmm. And then saying, look, this is how I want to do this. What do we need to do? And have them look at the data or tell you from their experience, okay, you've got to be at, 2 micros. If your tick to trade time is in 2 micros, you shouldn't be playing this game, the game that you want to play. Then you have to turn around and say, okay, how do I get to 2 micros? Well, I've got a 3 micro switch, so that's not going to work. So how do I get, a half micro switch? How do I get what kind of service? And then once you price all that out, you're going to be like, wow, that's a lot of commas. That's a lot of cash I'm going to put up front to maybe make money. Because then you might have been off, right? You might be off by order of magnitude. Maybe it's 1 micro. Now getting from 2 to 1 doesn't cut it anymore. So I think that the biggest discouragement is around, do you want to put the cash in? Do you want to really set all of that up? And even once you set it up, you're going to be on a treadmill. You're going to be on a treadmill of making it work, because it might work today, and then next week, like I said, something changes. You don't know why it doesn't work. Now you're going to be sweating figuring it out because you've already committed to this long-term contract of paying for co-location and servers and people and everything else. So it's a challenge.
Pointedly, you didn't say to me, well, you don't really know much about trading in the markets. Like you don't have any investment strategies. So that's not apparently going to prevent me from starting this business, because I could just shoot darts at the wall. As long as I can do it quickly enough, I might pull it off. That's sort of what I'm hearing. Is that the wrong takeaway?
I don't know if that's exactly true. I guess I hand waved and assumed that you would hire the expertise you needed.
Okay.
To figure that part out. That you're just saying, like, I mean, if you told me you wanted to start a restaurant, and I would assume that you would hire servers and chefs and
people to
interior designer, like all like. I assume you're not doing it yourself. Maybe I'm wrong. Maybe you want to do all of it yourself, in which case there would be a curve to learn before you even got there.
Okay. So that was implied.
To me, that was implied. Yeah.
Mike, you got something?
Should I short my lithium mining stocks?
I don't know. That's very far from what I know.
Mike's pet project lately is lithium. All right, Bob. Yeah. You have told us some amazing stories. I think there's probably a lot we didn't get to here. So maybe we'll listen back to this and maybe have you on another time in the future to talk more. And some of your other experience, I think, would be relevant for us to talk about too. What you're doing now sounds really interesting, right?
Yeah, absolutely. I would love to. That would be really fun. This is a nice conversation.
Just to follow that up, Bob now is working on autonomous driving. So I don't know if you can. Are you able to come on and talk about that in the future? You think?
Yeah, probably. There's probably a way we can talk about it, at least in the abstract and like some of the challenges and kind of go from there.
Okay, that sounds great. Thanks so much for coming on today, Bob. It was really a pleasure having you on.
Great. Thanks very much for having me. Yeah, nice talking with you guys.
So this has been Picture Me Coding. My name is Eric Aker. Today we had Bob Farzin on talking about high frequency trading, and we will see you again in the future. Bye, Mike. Mike, you got to say bye.
Bye.
That's my co-host, Mike Mull, everybody. He says bye too. Bye, Bob.
Bye bye.
See y'all later.